Hey, thank you for taking the time to click on today's video. I've been getting a lot of questions about what to expect in 2023 when it comes to investing. 2022 has obviously been a wild ride. Ever since the beginning of the year, we've had all sorts of volatility due to what the Federal Reserve is doing in raising interest rates to try to stave off this inflation. And the question becomes, what are they going to do in 2023? Well, my best guess, and from what I've seen in times past, and I've done this for over 2.5 decades, is that we have to remember a very cliche phrase, but one that is very, very true. And that is, do not fight the Fed. When it comes to combating inflation within our country, we have to realize that the Federal Reserve has a job to do. This Federal Reserve in particular seems extremely detailed to the task of reducing inflation and doing it in such a way that it's going to be creating volatility. It's going to be creating a contracting economy over the course of 2023. We have to remember that inflation is something that we have always experienced, but over the course of the last 2 decades, we've experienced probably the lowest rate of inflation that we've seen in any other generation. On average, inflation has run between 1.5% to 3%. And when things are headed in a direction in which we're seeing bacon being sold for $7 and $8 a pound, we know darn well that that bacon's not worth that price. It's something where we know that inflation is very easily turned into hyperinflation. And so does the Federal Reserve. This is the reason why they're wanting to tackle this and to be as assertive with the interest rates and the interest rate hikes as is possible. Now, as of just a week ago, we know that the inflation rate has dropped from 7.7% to 7.1%, a larger drop in inflation than what we have really expected. However, with that, the Federal Reserve has said that they are committed to raising interest rates. Their peak rate, they estimated, was 5.1%, but have also made total complete conviction comments that would indicate that interest rates may go as high as 5.5%. So what does this mean for you? What it means is that in 2023, you better be covering your six. You better be absolutely making sure that you're paying attention to your 401k, you're paying attention to your investments that are within the market, and considering whether or not your asset allocation is going to be properly defending you. In many respects, we have seen since the turn of the century, the stock market lose 50%, the stock market lose 63%, the stock market lose 25%, the stock market lose 37%. As of right now, the S&P 500 is down by 20, nearing 21%. All because we know that the responsibility of the Federal Reserve to handle this inflation is to contract the economy, to slow the economy. We need higher unemployment. We need fewer jobs. We need less wage increases. We need a number of different cuts all across the economy. And this is not going to bode well, I'm afraid, for equities. So if you have a majority of your money sitting in mutual funds, if you have a majority of your money sitting in investments that you really don't pay attention to, somehow you've bought into the idea of just, well, we're just going to buy it and let it ride without really managing it, I encourage you, take a look at your asset allocation. Make absolutely certain that what you're owning is going to be more on the value-based side, something that's also going to be producing you 3, 4, 5% in interest and dividends. Making certain that if you're in a 401k, you've got the current allocation potentially more conservative, while you've got your current deferrals, what you're putting into that 401k, more aggressive, so that you can take advantage of the discounted prices and the volatility that's in existence today. If you're in retirement, I only have one thing to say: income. Income the right way. If you're nearing retirement and you believe that 2023 may indeed be the year in which you retire, you have to look at your asset allocation, making certain that you don't continue to lose money, but rather that you defend your principal and that you get that principal producing income the right way through interest and dividends, so you're not having to sell shares at a loss in order to create that income, creating a circumstance for you in which you may never, ever recover. Thanks so much for watching. I encourage you, if you like our little videos, give us a thumbs up, share this with your friends, and if you like our little video, click that subscribe button down there, and we will notify you every time we have a weekly video. As always, thanks so much for watching, and remember, it's up to you to make today a great day.